Welcome. In this presentation, we will explore how relief funding affects your taxes. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. In today's conversation, we will discuss how to recognize key relief programs and their general tax implications, identify the general impacts of relief programs on tax filings, and use this information as a resource as you prepare to file your taxes. This information is intended to serve as one of many resources in your toolkit. It is not a substitute for, nor should it be construed as personalized advice from a tax preparer. Both the state and the United States federal government dedicated many resources to support child care programs through the COVID-19 pandemic. Relief funding saved many businesses from permanent closure, perhaps even your own. While these relief funds were highly needed and well used, many childcare business owners have wondered how this funding will affect their taxes. Different relief funding programs will have varying impacts on your federal and state taxes because funding sources are governed by different tax laws. Most state relief programs, including Stable, provide funding to cover costs you have already paid or will need to pay soon. Consequently, you must report the funds as income on your federal taxes in the year that you receive the payment. This means that the federal government will tax you grant money at your federal income tax rate. Because you will need to pay taxes on relief funds, your tax bill will most likely increase. However, this can be offset by claiming expenses paid for by the grant as a business deduction. Let's look into the upsides of relief funding in the tax process. First, federal taxes on relief funds do not affect how greatly you are taxed on your earned income. The additional tax money you are paying is being taken out of the funds you received from the grant. Second, expenses covered by the grant continue to qualify as a deduction. Let's look at an example case. Example: Ashley was eligible for Stable, and she received a total of $5,400 in support in 2022. Ashley allocates the money to her rent and utilities. When Ashley does her 2022 taxes, she can still report rent and utilities as expenses. They qualify as eligible deductions. This means that Ashley is reducing her tax burden by deducting eligible expenses, even though those expenses were paid from relief funds, rather than Ashley's earned income. Ashley's 2022 earned income is $40,000. As a single filer in 2022, Ashley would owe the federal government $8,581.10 in taxes if she did not receive a grant. However, Ashley needs to add the additional relief grant she received to her income. Ashley adds the $5,400 in relief funds to her taxable income. Now Ashley's total income is $45,400. Since Ashley is in the 22% federal tax bracket, she is taxed an additional $380.80 on the $5,400 relief grant, which increases her federal tax bill from $8,581.10 to $8,961.92. Although Ashley's federal tax bill did increase by $380.80, Ashley was able to directly put $5,019.18 of Stable grant funds toward her expenses. Ultimately, Ashley ended up with more money than she otherwise would have and was able to reduce her tax burden using relief-funded deductions. The receipt of Stable allowed Ashley to help her business and her family. You may have received the Employee Retention Tax Credit and/or the Family's First Coronavirus Response Act to help reimburse payroll expenses that you maintained while your business operations were impacted by the pandemic. Both the ERTC and FFCRA are refundable tax credits meant to offset wages that your business paid out. Funds received from the credits are taxable and will be included in your gross income for federal or state tax purposes. Please consult with your tax professional regarding these tax credits. If you received in-kind gifts of tangible supplies rather than money to buy the supplies, you most likely will not face a tax liability. Consult with your accountant or tax preparer to determine the best way to record the donation. Any COVID-related funds and other money in the form of funding, stipends, etc., that owners of center and family home-based programs receive from DeKalb for their childcare projects will most likely be considered taxable income by the state and federal governments. Within this general rule, there are some distinctions for family providers. For example, if the owner of a family childcare learning home employs a teacher and receives financial supports earmarked just for teachers, those funds are income to the teacher, but not to the owner. But if the family homeowner is the facility's only teacher and she receives those same financial supports, it is taxable income to her. The other wrinkle is that while the vast majority of the family home providers are licensed as individuals, and any individual benefits to that facility would be counted as taxable income to the owner, some family homes are registered as single-member LLCs. In those cases, the funds will be treated as income to the LLC, not personal income to the owner. To determine the proper and legal way to treat the federal relief funds you receive for income tax purposes, please consult your tax advisor. You should receive 1099 forms from DeKalb, ClassWallet, and similar funding sources for all the monetary payouts you or your child care business received during the tax year. The 1099s will help you and your tax advisor identify the benefits you need to include in your tax filing or filings, and how to treat them. For CAPS providers, the 1099s will include the total of both CAPS and stable payments. They will also receive an invoice from Maximus with details to understand which part of that total amount is for CAPS and which is for stable. If you received pandemic relief funds, it has likely been, and will continue to be, critical to your childcare business's financial operations and recovery. Even though this support can increase your tax liability, the new income that it offers you is valuable. The best way to prepare for this taxation is to organize your expense documentation, such as receipts, payroll, 1099s, etc., and differentiate the sources of income used to pay for your potential deductions for federal versus state purposes. This is because what you are allowed to deduct may vary for your federal versus state tax filings. You should then set aside an amount of funds equal to your marginal tax rate so that you are prepared to pay any owed tax. If you are unsure, you can use 22%, which is the most common tax rate in the U.S. For more childcare business tax resources, visit www.civstrat.com/taxes. For more information, visit the DeKalb Thriving Child Care Business Academy website. If you have questions about the Academy, send them to the email address on the screen. And be sure to visit the Civitas Strategies YouTube channel for more valuable resources to support you and your business.